The truth about banks, money and credit unveiled. Banks are fundamental to the economy, acting as intermediaries between savers and borrowers. They facilitate transactions, provide credit, and help manage financial risks. By offering a safe place for deposits and enabling efficient payment systems, banks support both individual financial stability and broader economic growth. The history of banking dates back to ancient civilizations, where merchants offered loans to farmers and traders. Over time, banking evolved with the establishment of the first modern banks in Renaissance Italy. These institutions laid the groundwork for the complex financial systems we see today, adapting to meet ever-changing economic needs. Modern banks have transformed significantly, driven by technological advancements and regulatory changes. They now offer a wide range of services beyond traditional banking, including investment products, insurance, and financial advisory. This evolution reflects the dynamic nature of the financial landscape and the growing demands of consumers and businesses alike. Banks come in various forms, each serving distinct functions. Commercial banks cater to individuals and businesses, offering deposit accounts and loans. Investment banks specialize in capital markets, assisting companies with raising funds. Central banks, such as the Federal Reserve, oversee monetary policy and ensure financial system stability, playing a crucial regulatory role. Banks generate revenue primarily through interest earned on loans and various fees. They charge borrowers higher interest rates than what they pay to depositors, creating a profit margin. Additionally, banks levy fees for services like account maintenance, overdrafts, and ATM usage, contributing to their overall profitability and operational sustainability. Central banks play a pivotal role in the financial system by regulating monetary policy, ensuring financial stability, and acting as a lender of last resort. They manage the nation's money supply and interest rates, striving to maintain low inflation and high employment. Their decisions significantly impact the broader economy. Banks create money through fractional reserve banking, a system where they keep a fraction of deposits as reserves and lend out the rest. This process multiplies the initial deposit amount, effectively increasing the money supply. It is a fundamental mechanism for economic growth and liquidity in the financial system. Bank reserves and deposits are crucial elements in banking operations. Reserves are portions of deposits not loaned out, held to meet withdrawal demands. Deposits are funds placed by customers in bank accounts. The balance between reserves and loans is essential for ensuring banks' liquidity and stability. The loan creation process involves banks assessing borrowers' creditworthiness before approving loans. Once approved, the bank credits the borrower's account, effectively creating new money. This ability to generate loans is vital for economic development, enabling consumers and businesses to invest, expand, and drive growth. Credit is indispensable to the economy, enabling individuals and businesses to make significant purchases and investments. It facilitates economic activity by allowing for the smooth flow of capital. Access to credit helps spur innovation, entrepreneurship, and overall economic development, making it a cornerstone of modern financial systems. Risk assessment and creditworthiness are crucial in banking, ensuring that loans are granted to individuals and businesses likely to repay. Banks use credit scores, financial history, employment status, and other factors to evaluate potential borrowers. This process helps minimize defaults and maintain financial stability within the banking system. Interest rates are determined by various factors, including central bank policies, inflation, and market demand for credit. These rates influence borrowing costs and savings returns. Banks set interest rates based on the cost of funds, competition, and risk assessment, impacting how much individuals and businesses can borrow. Interest rates significantly affect loans and savings. Lower rates encourage borrowing and spending, stimulating economic growth. Conversely, higher rates may deter borrowing but incentivize saving, controlling inflation. Banks balance these factors to maintain profitability while supporting economic stability and growth. Secured loans require collateral, offering lenders protection in case of default. Common collateral includes real estate, vehicles, or savings accounts. These loans typically have lower interest rates due to reduced risk. In contrast, unsecured loans rely solely on the borrower's creditworthiness and often carry higher interest rates due to increased risk. Collateral plays a vital role in banking by providing security for lenders. It reduces the risk of lending and enables borrowers to access larger loan amounts or better terms. Collateral ensures that lenders can recover some value if a borrower defaults, maintaining trust and stability in the financial system. Personal loans provide individuals with financial flexibility, allowing them to cover unexpected expenses, consolidate debt, or fund significant purchases. Typically unsecured, these loans rely on creditworthiness rather than collateral. Borrowers should understand interest rates, repayment terms, and potential fees to make informed decisions and avoid unnecessary financial strain. Mortgages are crucial for homeownership, enabling buyers to spread the cost of a property over many years. Lenders assess income, credit scores, and property value to determine loan eligibility. Fixed or variable interest rates impact the total repayment amount, making it vital to choose the right mortgage type. Business loans play a pivotal role in economic growth by providing entrepreneurs and companies with the capital needed for expansion, equipment, and operations. Lenders evaluate business plans, financial statements, and market potential. Successful loans can lead to job creation, innovation, and increased market competition. Credit cards offer a convenient form of credit, allowing users to make purchases and pay for them later. They can help build credit history if used responsibly. However, high interest rates and fees can lead to significant debt if balances are not paid in full each month, requiring careful management. Credit card debt poses risks due to high interest rates and potential for accumulating balances. Unmanageable debt can harm credit scores and financial stability. Consumers should aim to pay more than the minimum monthly payment, avoid unnecessary purchases, and consider lower interest options to mitigate these risks. Banks employ various strategies to manage risk, including diversification, risk assessment, and the use of financial instruments like derivatives. They also maintain capital reserves to absorb potential losses and follow strict regulatory guidelines. Effective risk management ensures banks remain stable and can continue to lend and support economic activities. Credit bureaus play a critical role in the banking system by collecting and maintaining individuals' credit information. They provide lenders with credit reports that help assess the creditworthiness of potential borrowers. Accurate credit information enables banks to make informed lending decisions, reducing the risk of defaults and financial losses. Credit scores are calculated using various factors, including payment history, outstanding debt, credit history length, types of credit used, and recent credit inquiries. These scores provide a numerical representation of a person's creditworthiness. Higher credit scores typically result in better loan terms and lower interest rates for borrowers. Maintaining a good credit score is crucial for financial health. It affects the ability to secure loans, rent apartments, and sometimes even gain employment. Timely bill payments, low credit card balances, and a mix of credit types contribute positively. Regularly monitoring credit reports also helps identify and correct errors. Banking regulations and oversight are essential for maintaining the stability and integrity of the financial system. Regulatory bodies enforce rules to ensure banks operate safely and fairly. These regulations protect consumers, promote competition, and prevent financial crises by requiring banks to maintain adequate capital and manage risks appropriately. Financial markets are integral to banking, providing platforms for banks to manage liquidity, raise capital, and invest. They enable banks to buy and sell financial instruments, influencing their profitability and stability. Through interactions in these markets, banks can diversify their portfolios, mitigate risks, and support economic growth. Banks play a crucial role in supporting small businesses by offering financing options like loans and lines of credit. These financial services help businesses manage cash flow, invest in growth opportunities, and navigate economic challenges. By fostering entrepreneurship and innovation, banks contribute significantly to job creation and economic development. The digital transformation of banking has revolutionized the industry, making financial services more accessible and efficient. Through digital platforms, banks offer seamless customer experiences, enhanced security, and innovative solutions. This shift has also driven operational efficiency, reducing costs, and enabling banks to better serve their customers. Online banking provides unmatched convenience, allowing customers to manage their finances anytime, anywhere. With features like bill payments, fund transfers, and account monitoring, it simplifies financial management. Enhanced security measures ensure the safety of transactions, making online banking a preferred choice for many individuals and businesses. Mobile banking offers the ultimate flexibility, putting financial control in the palms of customers' hands. By using apps, users can perform various transactions, from checking balances to transferring funds, with ease. The benefits include real-time alerts and personalized services, making mobile banking an indispensable tool in today's fast-paced world. Banks are rapidly evolving through fintech innovations, transforming traditional banking. Digital wallets, AI-driven financial services, and blockchain technology offer unprecedented convenience and efficiency. These advancements enable faster transactions, personalized customer experiences, and enhanced security measures, fundamentally reshaping the landscape of financial services and customer interactions. Economic crises challenge banks to adapt swiftly, ensuring liquidity and stability. Through measures like loan restructuring and government-backed programs, banks mitigate economic shocks. Their proactive strategies, including stress testing and contingency planning, are essential in maintaining confidence and supporting recovery during financial downturns. Financial inclusion is a key role of banks, promoting access to financial services for underserved populations. By offering affordable banking solutions, microloans, and mobile banking, banks empower individuals and small businesses, fostering economic growth and reducing poverty. Inclusive banking practices bridge the gap between traditional finance and marginalized communities. Ethical banking emphasizes transparency, fairness, and social responsibility. Banks committed to ethical practices prioritize customer welfare, environmental sustainability, and community development. By avoiding investments in harmful industries and supporting ethical projects, these banks build trust and contribute to a more equitable and sustainable economy. Sustainable banking practices integrate environmental, social, and governance (ESG) criteria into financial decision-making. Banks adopting these practices invest in green projects, promote responsible lending, and reduce their carbon footprint. By prioritizing sustainability, banks play a crucial role in addressing climate change and promoting long-term economic resilience. Banks play a crucial role in community development by offering financial products and services tailored to local needs. They provide loans for small businesses, support affordable housing projects, and fund community initiatives. By fostering economic growth and stability, banks help create vibrant, sustainable communities that benefit everyone. The global banking system is interconnected, with banks around the world working together to facilitate international trade, investment, and economic stability. This interconnectedness allows for the efficient flow of capital and resources, promoting global economic growth and development while managing risks associated with cross-border transactions. Currency exchange in banks enables individuals and businesses to convert one currency into another, facilitating international trade and travel. Banks use exchange rates determined by the foreign exchange market, ensuring fair and transparent transactions. This service supports global commerce by making it easier to conduct business across borders. Banks play a vital role in international trade by providing essential financial services such as letters of credit, trade finance, and foreign exchange. These services help businesses manage risks, secure funding, and navigate complex regulatory environments, ultimately promoting global economic growth and fostering stronger international relationships. Banks are indispensable to modern society, driving economic growth, stability, and innovation. They facilitate financial transactions, provide credit, and support community development. As the financial landscape evolves, banks continue to adapt, leveraging technology and sustainable practices to meet the needs of individuals, businesses, and communities worldwide.